Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
In a surprising move over the weekend, the Reserve Bank and SEBI, both the regulators, released simultaneous statements to try and talk up the markets and calm some frayed nerves. But that did little to stop the sell-off, and stocks fell for the fifth straight day. The Sensex has lost over 500 points today. The Nifty is below the 11,000 mark. Both the indices closing at their lowest level that we've seen in 2 months. Mid-caps and bank stocks continue to see sharp cuts. In fact, financials accounted for 80% of the market's fall. So what exactly is spooking the markets? Today, it was a heady cocktail of crude oil prices, which have hit their highest level in 4 years, crossing $80 per barrel. Global market were weak due to trade tensions, and back home, fears over liquidity remain in the debt market, and the situation at IL&FS is adding fuel to the fire. So joining us now to discuss the issues plaguing the market, our team of in-house experts, Lata, Anuj, Manisha. But Anuj, let me come to you first. You know, what a day we saw today on Dalal Street. Yesterday, we saw both the regulators coming out and saying that, look, we are going to be out there watching every move. You had the finance minister tweeting this morning saying that liquidity will be provided, but nothing worked. Bears seem to be in total control.
Well, there are market cycles and there are market cycles. This is one of those cycles which is playing out. And frankly, it's classical case of market moving ahead of the curve. The market peaked out and moved from greed to fear in a matter of a month. It moved to a put-call ratio of 2, and we were worried that perhaps something is amiss here. Triggers always come later. The market senses it first, and the market did that. Now we are, of course, talking about crude, rupee, debt freeze. This market knew about it all along. And the best example of that is the way some of the large haloed stocks have fallen. Nothing is sacred in this market. Bajaj Finance is now corrected 25% from highs. Eicher Motors, HDFC, HDFC Bank are all down about 15% from the highs. Again, you know, the selling had started much before, all these problems had surfaced. A lot of these stocks had started to see selling. So the market was always a step ahead of all of us and was giving you all these indications. Now, the obvious question is, what next? Look, if you're a trader, this is a moving trade. We are in expiry week. The bears have all the momentum. 10,950 is just the last remaining support. My sense is it's a matter of when and not if it goes. 200-day moving average of 10,750 is likelihood. The market likely to panic at extreme or likely to bottom at extreme panic now. You could be looking at, say, a put-call ratio of 1 or 0.9 to 1. That's where historically it bottoms out. We're at 1.05 right now, which may coincide perhaps with this expiry, but things are looking rather weak right now.
All right, so the market is looking weak, and that is what the internal suggests. Anuj, many thanks for joining us with that. What is the near-term outlook? Will we see a further correction? Let's hear in some market opinion and take us through what they make of the kind of moves that we've seen since Friday.
I would say India is essentially caught in cross currents of a variety of global developments where, looking at stuff like trade frictions, which has been weighing on Asian equity markets quite a lot, hasn't really impacted India so much. So India, as a relative outperformer, was looking quite good until recently. The biggest near-term risk remains oil prices. And with what we're seeing in terms of the sanctions, the U.S. sanctions on Iranian oil being exported, if that really continues to tighten the oil markets as we expect, then we could easily see Brent oil going up to $90 a barrel in the near term.
Macros which are scaring, and obviously crude at 80 is, with the rupee where it is the equivalent of 95, or we're getting towards that 100 level. And I'm sure if I would have asked you 6 months ago, Lata, what would you think the rupee or interest rates would be if the oil price was the equivalent of 100, and you'll be saying a lot worse than it is today. So I think interest rates are going to be continue to be pressured upwards in the very short term. I think the rupee is going to be pressured down in the short term. And that just causes its own kind of problems for India Inc.
So typically when panic happens, it's very difficult to say where it's going to settle down. But still, according to us, possibly it will take another, Nifty can come down by another 150, 200 points, not impossible to imagine. But if you are a longer-term investor and possibly ready to overcome the journey of those assembly elections, the central elections, and looking for 12 to 15 months, I think this certainly would be the time to buy at on a very selective basis, and maybe you can do a kind of an SIP in your investments spread over next 12 to 15 months.
Well, that's the view. We could see another 100 to 150 points being taken from the Nifty. But Lata, let me come to you now and talk about what we are seeing specifically in the NBFC space. As Anuj was pointing out, nothing seems to be sacred. Bajaj Finance down about 8% at one point of the day today. You know, there is this concern about liquidity. The government, the finance minister, no less, trying to come out this morning and say, look, we will take care of liquidity in the debt market. It doesn't seem to be working. What is broken, Lata?
Okay. Well, in the first place, I don't agree with Anuj's interpretation that markets always know better and they always price correctly. Clearly, they mispriced NBFCs. You saw the writing on the wall that the cost of money is getting expensive. But nevertheless, all through August, NBFC stocks continued to be bid up higher and they had to be creamed off at some point in time. NBFC stocks should have been falling in August because it was already well known that yields all over the world are rising. Crude prices are rising, so our yields also will rise. The July trade deficit was known to everyone. How will a central bank cool interest demand? They can only hike rates. So, you know, clearly the reading was wrong, and therefore now it is selling out in panic. What's happening in the market, it looks like, you know, the traders are just hitting one stop loss after the other, and there is a tumble. But let me just come to the debt market and, you know, the statements made by SEBI and Reserve Bank jointly that they are watching the market appears to have had impact. Because mutual funds, most of them told me that they didn't see any manic redemptions. Now, I don't expect all of them to tell me even if they have redemptions. So I asked even primary dealers, I asked others. Most of them said that they did not notice anything, but, you know, data is still coming in. It doesn't look like there was any manic redemptions from companies. Usually large corporates invest in fixed income funds. So when they redeem big time. It doesn't look like there was that kind of turmoil. But no deal got done either. But it's not as if, you know, NBFC paper is traded on a daily basis. Today, dealers said there were deals being done, but of non-NBFC paper, non-financial paper. Manufacturing companies' bonds got traded. NBFC, not much. So the yields are high. That is the basic point. The yield of one paper went to 11% last week, but that is not the benchmark. It is possible that today a stray deal could have gotten done even at 10.5 or 10. So the point is yields have risen, and that is what is scaring the equity market. The debt market has come to terms with higher yield, but they will not touch NBFC paper for some time till the scare gets over. So I don't see any of the NBFC companies going to raise money from mutual funds anytime soon. And that is what is hurting the equity markets. If these guys are not going to take fresh funds, then they will not be able to grow at the rate they grew last year. And we are giving them a price as if they will grow at the same pace that they grew last year for the next 2 years. Now it looks like they're not raising money, so they will not be able to raise. They will not be able to, you know, give volumes. Also, even if they raise money, they will raise money at least 175 basis points more expensively. Now, is there demand for that? They are not very sure. That is why today you saw even M&M falling, Eicher Motors falling. Who were the marquee guys who fell? Next to India Bulls, it was M&M and Eicher. Clearly, because you feel consumer goods cannot be purchased at this high in EMI and, of course, this high in insurance and petrol price as well. Now, I just want to read out some numbers which Credit Suisse said have given, and it proves the point why there is trouble with NBFCs. This is the data. The share of non-bank sources that NBFCs tapped rose to 74% as of March. You know, some years back, they would depend 74% on banks and, you know, 20% on markets. By March, they were depending 75% on the markets. And what does markets mean? It was largely mutual funds. Now, 41% of their paper is going to mature in the next 6 months. So that is the kind of money that will come back and that may not be refinanced by the mutual fund market. Why is Credit Suisse saying it will not be refinanced? Because they say mutual funds' total exposure to NBFC has risen 3 times in the last 2 years. So if they've trebled their exposure, they want to pull back. They are still well within SEBI limits. SEBI limits is you can't be exposed to one sector more than 25%. They are probably at 17%. But going by the scare of the last few weeks and the IIFL memory, mutual funds are unlikely to increase their exposure to NBFCs. So where will NBFCs go? They will have to go back to the banking sector. And remember, banks are also competing to lend to the same people, consumer durables, to housing finance. So they will have to perhaps get money, but get money very expensively. We spoke to Rajneesh Kumar, chairman of SBI, and you listen to what he said. He says, I am more than willing to lend to NBFCs. I'm not sure if all the other bankers will say that.
We keep on watching the developments, but as of now, the NBFCs with which bank has relationship, and if there is any requirement or if they approach, then whatever we do in the normal course of our credit due diligence, and based on that, there is no problem. In fact, in yesterday's release, I have also mentioned about SBI's willingness to partner with NBFCs for co-lending model. This we have been planning for about a year now. And the concerns on NBFC because of IL&FS, I think there is a extreme reaction which is totally unwarranted.
Okay, so Shireen, that's the SBI chairman saying that he has more headroom to lend, but the Credit Suisse report says that total banking sector exposure to NBFCs is 6%, which is kind of the long-term average, and therefore Credit Suisse doesn't expect banks are going to increase lending to NBFCs.
Okay, Lata, I'm going to come back to you to talk about the rupee in just a bit, but let's just continue with our conversation on NBFCs and focus a little bit on the NBFC stocks. Will they continue to see the kind of pressure that we've seen over the last few days in the short term? Market opinion on what they make of the move in the NBFC stocks.
I think anything that's straight at this point of time in terms of valuation is obviously susceptible to profit booking and correction and would be a perfect target to build short positions on, and that's exactly what's happening in the last few days. But I think towards the end of the day, or probably tomorrow sometime, some amount of buying would emerge. May not be in the old names that have been in fancy over the last year or so, the HDFC banks and the Kodaks and those of the business, but maybe in some other names, buying would emerge, which are obviously facing the collateral damage.
I don't think there's anything specifically going wrong with financials. I think we just got too optimistic about wholesale market funded lending models. So correction was long overdue. What precise reason the correction happens, whether it's IL&FS, whether it's the 10-year bond yield, the rupee, in a way is somewhat secondary. You can't logically say that 40% of the weightage of the Nifty should be financials. The financials have been significantly overvalued for I would say, good year and a half, and a long overdue correction is underway there.
The big theme was a downgrade by a AAA rated company. So we have enough NPAs in the system, right? And some things are getting resolved, and if you will take some time. But the big theme was a AAA entity going to default. NBFC is a tricky thing. In NBFC, people typically feel NBFC is very high risk. So I've been hearing this from the last 25 years. But believe me, a well-managed NBFC, according to me, is better than a well-managed, on the risk side, it's better than a well-managed manufacturing company.
Well, the debate continues there on NBFCs. But Lata, I want to talk to you specifically about IL&FS. And, there is one camp, specifically a camp within the government that believes that this is a matter that's being blown out of proportion, and similar views being echoed even within the market. But the fact of the matter is that someone now needs to provide some sort of a lifeline. What is going to be the impact of IL&FS as far as the market's mood is concerned?
Well, everybody is now waiting for September 28 when all the shareholders will be, addressed by RBI. And September 29th is the IL&FS, the parent company's board meeting. Now, there are bits and pieces of information. The shareholders are LIC 25%, Oryx of Japan 23%, and then a whole range of people with between 5, 6, 7%. 7% around would be HDFC and Central Bank. SBI has about 6.5%. So that's the entire range. And yes, Abu Dhabi Investment Authority also has a fairly high stake, above 7% in this. Now, Reserve Bank can perhaps, and government can goad LIC and SBI. But what authority do they have to tell HDFC to subscribe to the rights issue? I don't know. I'm not very sure. Market opinion is divided on whether private parties. Central Bank, of course, can't be told because they are in the prompt and corrective action list. So they can't assume more risk. Likewise, what authority would they have on Oryx and Abu Dhabi Authority to spend money on the Indian infrastructure company? There was news in the Business Standard that Oryx is offered to all buy out the entire company. Now, when we asked other shareholders who are involved, they said they did not confirm it. They said, no, we haven't heard it. So it looks like there could be a miscomprehension. Oryx actually holds 49% in a power project in which IL&FS parent holds 51%, and it appears that Oryx is ready to buy that entire stake. So it's in one of the SPVs that maybe Oryx is willing to buy. We don't have confirmation on whether Oryx is willing to put a great deal of money. So it's at the moment not that 3,500 crore of rights issue anyway is extremely small compared to the asking amount, which is 25,000 crores of short-term paper, which will mature in the next 7 months. Some of it is just commercial paper, some of it is old bonds with a residual maturity of 6 months. Now, from where they're going to get that money looks unlikely. So some bankers are talking of resolution. That is, the creditors will have to come and they will have to, everybody takes a haircut of about 10% or 20% or thereabouts. Yeah. Now, that would be possible. It will not be a very great deal. But, the record of the banking sector to arrive at a solution very quickly is not very impressive. They have not been, giving their approvals very quickly. So, at the moment, I don't think this IL&FS pain is going away quickly. I think, we will be dangling, but waiting and waiting for more information, like we have been waiting for, forever for those 12 companies to be resolved. Only 2 have been resolved. The old marquee case. I don't know, IL&FS can take a very long time to get resolved. Until then, they will be marked as NPA. The market will go through pain. It doesn't look like it's a one-shot solution. I don't think Nirvana is on September 29th.
Sure. No, I don't believe that it will be the case. But nevertheless, the next development perhaps in this story, more on the 28th and the 29th of September. But let's now talk about the big global risk, and that comes in from crude oil. Manisha standing by. Manisha, 4-year high. We're now seeing predictions of $90 and $100 per barrel. What is going on in the crude market?
Well, plenty, Shireen, and all of that has been on the very bullish fundamentals. I want to lay out quick 6 points for you, and that would tell you on why the crude oil prices are on a boil. One, of course, is the Sunday meeting, which we have been talking about today, where the OPEC and the allies, in very clear words, have said that they are not looking to increase additional output anytime soon. They would want to focus on compliance, but they do see demand on the stronger side, especially for the months of October and November. The second part really is about the Iran sanctions, and the markets have been tightening ahead of that. There are various reports now suggesting that you could see 1.2 to 2 million barrels per day being knocked off by the markets come 4th of November. So that, of course, has been very bullish. We already have seen Iran exports decline by 38% in the last 3 months itself. The third important point, of course, comes in from US, where we have seen the crude inventories decline to the lowest levels since 2015, and that has been a big support to the prices as well. The fourth, of course, is the unplanned output cuts that we have seen from OPEC countries like Venezuela, Libya, Algeria, etc. The markets had not factored that in. The other important point, of course, is that various reports that we have seen come in, whether it is from OPEC or the EIA, say that the global demand growth or the global demand number will touch 100 million barrels per day very soon. So with the kind of demand estimates we are working with and the supply concerns on the other side, the crude oil prices are headed higher. all the reports that have come in last 2 or 3 days, whether it's from JP Morgan, TD Securities, Trafigura, Mercuria, they all point out saying that $90 to $100 per barrel is what you could be expecting in the early 2019 itself. I mean, you would want to put out a case where India today perhaps said that they would want to stop imports, halt imports, and perhaps for the near term dip into their commercial inventories. But we spoke to some global experts and they said India will not be able to do that for a very long time. They would not be able to pause. So whatever the prices are, the consuming countries will continue to import, and that's an added push for the crude oil prices to move higher from here.
We're going to assess the market and where we are, and as we all know, we have achieved pretty much the objectives that we set out in 2016 to achieve. Markets are relatively balanced. Supply and demand are in line. Inventories are where we targeted them to be. And we're looking beyond the current agreement now to 2019.
First of all, let me say that we are acting within the framework which has been agreed on in June, and we are within that framework. So there have been no infringements, there have been no stepping out of this by Russia or by any other country. In fact, we're at 129% conformity, so we still have not reached 100. And this is something which all sides have agreed to in June. We're all jointly as a group exerting effort to be able to achieve a balanced market, which means acting both when there is deficit and when there is surplus in order to counter those trends.
Well, those are the voices that are adding nervousness in the crude oil markets. Crossed 80 on Brent and back home in Mumbai ahead of 90 rupees per litre. That's the price on your screen. Well, in a bid to stem the fall in the rupee and rein in the current account deficit, the government is close to finalising a list of commodities that will attract higher import duty. Sources tell us that non-tariff restrictions may not be on the table at the moment. So what could attract higher tariffs? Precious stones, certain types of steel, electronic goods are all candidates, and sources also tell us that further import curbs on gold for now is unlikely, but we are awaiting a final confirmation. But these are the items that the government is likely to hike import duties on. But let's do a check on the rupee and where the weakness continued today. The currency ended the day at 72.63 to the dollar. It closed at 72.20 against the greenback on Friday. So Lata, let's talk a little bit about the currency now. What contributed to the rupee slide today? And, you know, if we do see these import curbs being announced by the government, whether it's today or over the next few days, what does the market make of the impact and the implications of that move?
Well, today there wasn't any panic in the rupee market. Like I said in the bond markets, it was not panic. No big, dollar purchase and therefore rupee crashing. But it had to fall because of the psychological impact of crude crossing 80 and the fact that that will mean obviously more of a trade deficit and a current account deficit problem. So at all levels, people were willing to buy dollars, but there was no manic buying of dollars. It's just that the number of dollar buyers were outnumbering the number of dollar sellers, and therefore the price of dollar kept rising. It was a gentle rise. I don't think the market is that enthused by this announcement of tariff increases on some goods. The point is, this news has been around. And now they would like to see what the news is and how much of a difference it can make to the trade deficit and therefore to the current account deficit. I think the pace of the fall has definitely slowed, and that is for two reasons. One, that globally the dollar itself has weakened a bit. At the moment, the dollar index is at 94. At the peak, it was at 95.6 and thereabouts. So dollar itself has eased somewhat. And secondly, even with the price of petrol, for instance, in Mumbai going up to 90 rupees plus and diesel going up, there are reports that demand for these products also is slightly waning. And that is exactly the way it should work. As people consume less, probably use carpools or public transport, automatically the amount of volume of consumption, the growth of consumption will slow, and that will have a positive impact on the trade deficit. Both the oil deficit and the non-oil deficit will respond to higher prices of imports and higher earnings from exports. So that's why the rupee is still falling, but it's falling way more gently, both for the domestic reason and for global reasons. Of course, the market will be interested to know what will be that list of import tariffs and if there will be some punishing rate on consumer goods, consumer electronics, which is fast becoming a very, very big item of import. But beyond that, I think they are waiting for the correction in the currency to effect a change in the trade deficit and the current account deficit. So the next number awaited will be the next trade deficit number.
Well, that certainly will be the case, but what we are getting to hear is that, the perception that the government put out that it was looking only at non-essential items, luxury items, etc., that's perhaps not going to be restricted to only that. The list is going to be wider and more diverse. All ministries have been asked to submit their recommendations. We've been reporting about that here on CNBC-TV18, the final call with the Finance Ministry, and we understand that it's just a matter of time before that list is now made public. But for now, from all of us here on the Editors Roundtable, thanks very much for watching. We'll be tracking the market action and any other related developments from all of us here. Goodbye. Thanks for watching.